Hey everyone, welcome back to Corporate Decoder. Today JVA just filed its Q2 2026 report and I am seeing some interesting trends in their coffee business. Quick note, this is not financial advice, just my take on public filings for educational purposes. While their net sales are down, their profits for the 6-month period are actually up, which is a bit of a mixed signal. So Coffee Holding Company Incorporated, the folks behind JVA, have filed their quarterly report for the period ending the 30th of April, 2026. This report gives us a look at how the company is doing financially, covering both a 3-month and a 6-month span. Let's dive straight into the numbers, starting with their balance sheet as of the 30th of April 2026, compared to the 31st of October 2025. Total assets stood at about $39 million on the 30th of April 2026, down slightly from over $42 million at the end of October 2025. Looking at liabilities, accounts payable and accrued expenses were around $4.4 million on the 30th of April 2026, a decrease from about $5.6 million in October 2025. Stockholders' equity, which is essentially what the owners of the company have in the business after all debts are paid, was about $29 million on the 30th of April 2026. This is up from just over $27.5 million in October 2025, which is a positive sign. Now, let's look at how the company performed in terms of making money. This is the Statement of Operations, showing their revenues and profits. For the 3 months ended the 30th of April 2026, net sales were about $22.1 million. This is a dip from nearly $23.3 million for the same period in 2025. However, if we look at the 6-month period, net sales actually increased from about $44.6 million in 2025 to over $47.6 million in 2026. This shows a bit of a complicated picture. Shorter sales periods show a decline, while longer ones show growth. Cost of sales, meaning the direct costs of making the products they sell, was about $18.6 million for the 3 months ended the 30th of April, 2026. This is a bit higher as a percentage of sales compared to 2025. Gross profit, which is what is left after you subtract the cost of sales from net sales, was around $3.5 million for the 3 months ended the 30th of April, 2026. This is down from over $3.7 million in the same period last year, but for the 6-month period, gross profit actually jumped from about $8.6 million in 2025 to over $9.6 million in 2026. Income from operations, a key measure of how well the core business is doing, was about $342,000 for the 3 months ended the 30th of April, 2026. This is significantly lower than the nearly $889,000 from the same period in 2025. However, for the 6-month period, operating income showed a healthy increase, going from about $2.4 million in 2025 to over $2.7 million in 2026. And finally, for this section, net income. For the 3 months ended the 30th of April 2026, the company reported a net income of about $262,000, down from over $644,000 in 2025. But again, looking at the longer 6-month period, net income rose from about $1.8 million in 2025 to nearly $1.9 million in 2026. So it seems the first quarter of 2026 was a bit rough, pulling down the overall performance for the shorter term, but the second quarter seems to have helped recover some ground. Let's take a look at the statement of changes in stockholders' equity. This shows how the owner's stake in the company has changed. As of the 31st of October 2025, total stockholders' equity was about $27.5 million. Retained earnings, which is the accumulated profit the company has kept over time, was $13.1 million. By the 30th of April 2026, stockholders' equity had grown to just over $29 million. The retained earnings increased to about $14.5 million. This growth in equity is largely due to the net income the company earned, even with paying out some dividends. Specifically, they declared a dividend of about $0.08 per share, which totaled over $467,000. Now, this is a crucial part of any financial report, the cash flow statement. It shows how much cash the company is actually generating and spending. For the 6 months ended the 30th of April 2026, the company generated over $6.6 million in cash from its operating activities. This is a massive improvement from the same period in 2025, when operating activities actually used over $1.5 million of cash. This change is a big deal, showing that the company is much more efficiently turning its sales into actual cash. In terms of investing activities, the company used about $1.1 million in the 6 months ended the 30th of April 2026. mainly for things like leasehold improvements and buying an investment. This is a bit more than the nearly $993,000 used in 2025. Looking at financing activities, which involves borrowing money and paying it back, things were quite different between the two periods. In the first 6 months of 2026, they used about $3.8 million, mostly to pay down a line of credit. This is a big change from the first 6 months of 2025, when they actually brought in $3 million from financing activities, likely by drawing on that credit line. Overall, the net change in cash and cash equivalents was a positive increase of about $1.6 million for the 6 months ended the 30th of April, 2026, bringing their total cash to over $2.3 million. This is a strong indicator of improved financial health. The company's core business is coffee operations. They roast, manufacture, package, and distribute coffee. They also sell green coffee, which is unroasted coffee beans, and even coffee roasting equipment. They break their coffee products into 3 main categories: wholesale green coffee, private label coffee, sold under other brands, and their own branded coffee. All of this is managed as a single operating segment because they all share customers, resources, and marketing efforts. Regarding their ability to pay their bills, the company seems stable. Their line of credit is due in December 2026. They are meeting their financial checkups called covenants. They have positive net income and a good amount of working capital, which is the money they have available for day-to-day operations. So, they don't seem to be in danger of not being able to meet their obligations in the near future. The financial statements are prepared using generally accepted accounting principles, or US GAAP. They are unaudited, which is typical for quarterly reports. The company mentions that they had no changes to their main accounting policies this period. They follow a standard 5-step process for recognizing revenue. This just means they make sure they've actually earned the money before they report it as sales. Here is a breakdown of their revenue by product line. For the 3 months ended the 30th of April 2026, packed coffee brought in about $14.2 million, while green coffee brought in about $7.9 million. For the 6-month period, packed coffee sales were higher, close to $30.9 million, and green coffee sales were around $16.7 million. Interestingly, the company identified a misclassification error. Some money that should have been listed as cost of sales was incorrectly put under selling and administrative expenses. They've corrected this. It meant that for the 3 months ended the 30th of April 2025, cost of sales went up by about $689,000, and selling and administrative expenses went down by the same amount. This didn't change their total profit, but it better reflects where the costs actually belong. Similar adjustments were made for other periods as well. On the 6th of November 2024, the company completed an acquisition called the Second Empire Acquisition. They bought assets from Empire Coffee Company for $800,000. This acquisition will help them roast and package coffee for both their existing customers and those from Empire Coffee. This means the results of Second Empire are included in the company's financials from that date forward. Inventories were about $19.5 million on the 30th of April 2026. This is a slight decrease from nearly $20.4 million at the end of October 2025. The majority of their inventory is green coffee. The company uses coffee futures and options contracts. They do this to help manage the risk of changing green coffee prices. These contracts are marked to their current value, and any gains or losses on them are included in their cost of sales. It can make their reported profits jump around a bit from period to period. For the 6 months ended the 30th of April 2026, the company reported a net gain of about $161,000 from these contracts. This is a big change from the prior year's 6-month period where they had a gain of over $1.4 million. This difference in hedging gains significantly impacts their cost of sales and overall profitability. Their line of credit, which is a flexible loan, has had its maturity date extended multiple times. Most recently, on the 4th of March 2026, it was pushed to the 28th of December 2026. The total amount they can borrow is $10 million. As of the 30th of April 2026, they had borrowed $2.65 million, down from $6.05 million in October 2025. This reduction in borrowed funds is a good sign for their liquidity. The company has a standard approach to accounting for income taxes. They report their tax expenses for the periods. For the 3 months ended the 30th of April 2026, income tax expense was about $40,000, and for the 6 months it was over $703,000. They also mention a new tax law enacted in July 2025, the One Big Beautiful Bill Act, which they are still assessing for its impact. Basic and diluted earnings per S-share. Tell us how much profit is allocated to each outstanding share of common stock. For the 3 months ended the 30th of April 2026, it was 5 cents per S-hair, down from 11 cents in 2025. For the 6-month period, it was 33 cents per share, an increase from 31 cents in 2025. Even with lower short-term profits, the longer-term earnings per share have improved. The company is generally not involved in any significant legal proceedings that would materially affect their financials. However, there is an interesting note about their CEO, Andrew Gordon. His employment agreement was amended in February 2026. His base salary was significantly reduced, but he became eligible for a large cash incentive bonus payable much later, in 2030, provided he remains employed. This is a long-term incentive tied to his continued service. They have operating leases for their facilities. As of the 30th of April 2026, the value of their right-of-use assets for these leases was about $1.8 million. The lease liabilities, meaning the money they owe for these leases, are split into current and long-term portions totaling over $2.1 million. They also mention a new lease taken on for the Second Empire acquisition and the exit from the Comfort Foods facility in Massachusetts, which resulted in an impairment of the associated right-of-use asset. The company used to have a non-qualified deferred compensation plan for its CEO where he deferred some salary. However, this plan was closed during the 6 months ended the 30th of April 2026, and there are no longer any assets or liabilities related to it. This section confirms they use the cost method for accounting for treasury stock, which is stock they bought back. They also have a stock option plan, the 2013 Equity Compensation Plan. As of the 30th of April 2026, there were 921,000 options outstanding. They did not record any stock based compensation expense in these periods because all options were already fully vested. In December 2025, the company invested $850,000 in the Rail Company LLC. This is a passive investment where they don't have control or significant influence over the other company, so it is accounted for at cost. As mentioned earlier, the company operates in one reportable segment, coffee. Their chief decision maker reviews performance based on operating income. The report shows net sales, cost of goods sold, gross profit, and operating income for their coffee segment. They use operating income to make decisions about investing profits, similar to how you might decide where to put your money for the best return. Moving on to the management's discussion and analysis. This is where the company explains the financial results in their own words. They describe themselves as an integrated wholesale coffee roaster and dealer, offering a wide range of coffee products. They believe this broad offering positions them well to handle coffee price fluctuations. Their operations involve selling wholesale green coffee, private label coffee, branded coffee, and selling coffee roasting equipment. They acknowledge that their results are affected by competition, customer retention, their hedging policy, and fluctuations in coffee prices and supply. They explain that green coffee prices can be volatile due to weather and other factors. While they buy from different countries to reduce risk, they can generally pass on price increases to customers. However, they acknowledge that intense competition can limit their ability to do so. They also discuss their hedging strategy using futures and options contracts. While this strategy aims to reduce price risk, they admit that it can lead to gains or losses that impact their cost of sales and profitability. They've been scaling back their use of these contracts because of market volatility. This section provides a more detailed comparison of their performance. For the 3 months ended the 30th of April 2026, net sales decreased by about 5.1%. This was mainly due to a sharp drop in green coffee prices, which led them to lower prices and increased promotions for their wholesale customers. Cost of sales as a percentage of net sales increased slightly due to higher product and packaging costs. Gross profit decreased, and operating expenses increased. This all led to a lower net income of $262,000 compared to over $644,000 in 2025. However, for the 6-month period, net sales increased by about 6.9%. This growth was driven by sales to existing and new customers, and the inclusion of the Second Empire acquisition. Cost of sales as a percentage of net sales decreased, partly due to better hedging results in 2026 compared to 2025. Gross profit and operating income increased significantly, leading to net income of nearly $1.9 million, up from $1.8 million in 2025. Their working capital, which is the difference between current assets and current liabilities, actually increased slightly to about $23.1 million and remained fairly stable. They appear to have enough cash and access to their line of credit to fund operations for at least the next year. They state that this section is not applicable. meaning they are not providing specific quantitative market risk disclosures beyond what is already covered. Here is something important. Management found that their internal controls over financial reporting were not effective. There were two main issues: inadequate system access controls that could lead to unauthorized changes, and a lack of proper controls for recording year-end vendor liabilities. These are called material weaknesses. They have a plan to fix these issues, but until they prove they are working, these weaknesses will remain. This part covers miscellaneous information. Under risk factors, they state there have been no material changes to the risks they previously disclosed in their 2025 annual report. This means the same risks like reliance on a single commodity or competition are still relevant. This lists the supporting documents filed with the report, such as amendments to employment agreements and certifications from their top executives. Now, let's talk about what this all means. The recent news suggests a 25% coffee price drop hurt Coffee Holdings' quarterly profit, which aligns with what we saw in the three-month financial results. Net sales were down and profits took a hit. However, the longer 6-month picture is much more positive. They posted a higher profit and improved cash flow, which aligns with the strong operating cash generation we saw. This indicates that while short-term market fluctuations like falling coffee prices can cause short-term pain, the company's overall operational improvements and diversified sales channels are helping it navigate these challenges over longer periods. The fact that they are showing growth in sales and profit in the 6-month period despite the weaker short-term performance is a testament to their management's ability to adapt. The decrease in their line of credit, meaning they are borrowing less, combined with the increase in retained earnings and overall equity, shows a move towards greater financial stability. My biggest concern is the material weakness in their internal controls. While they have a plan, until those controls are fixed and proven effective, there is always a risk of errors or fraud impacting their financials. However, the company's ability to generate strong operating cash flow and its positive net income trend over the 6-month period are very encouraging signs. I am looking for continued improvement in their sales and profitability, especially in navigating commodity price volatility and a successful remediation of their internal control issues. Alright, that is my take. Stay decoded. Oh, and the research tools I actually use are linked in the description. They help keep this channel going. Like, comment, subscribe, and join our Discord.